In this relatively quick video, we're going to take a brief look at the different approaches which exist to segmenting the equity investment universe. Equity investment universe being the title of the video. So first of all, we've got the possibility to segment equities by size and style. And the name suggests that there are two factors involved, so size and style. And what we will therefore get is a table, or as your book describes it, a matrix, if you want to illustrate or visualize the segmentation. So what the curriculum does is displays this with style in the sort of columns and size in the rows. Size is a very simple segmentation, well, relatively simple. We're talking about the size of the company. So the typical setup would be to split and dice these companies up into the large cap companies, the mid-sized or mid-cap companies, and of course small cap to close things off. So size will typically be measured by market capitalization, or cap, as hinted at in the names of the rows. Of course, you could measure size by some other criterion than market capitalization, but this is the typical one that we're focusing on here. On the other hand, we've got style, or in the columns we've got style, and this is not as not as easy to measure, or not as easy to really place a company into one of the so-called styles. What we typically distinguish is so-called value stocks on one end of the spectrum, and growth stocks on the other. But because companies may also display combinations of value and growth, we have a category called blend, to suggest that there is a blend of the two extremes. Your book says that this is also called core. So let me remind you how we sort of measure or quantify a style. Typically, what we will be looking at is the adoption or the use of some kind of scoring system. And in that scoring system, we will adopt or use several ratios. So using several ratios, metrics, such as most commonly price to earnings ratio. So companies that have a low price relative to their earnings, so relatively cheap companies, would be classified as value. On the other hand, companies with a high price to earnings would be typically classified as growth. Price to book is another one. Once again, a low ratio, a low price relative to the book value of a company's net assets would suggest value. And there are others as well, like dividend yield. So companies that have a high dividend yield, a high dividend relative to their price, would also be value stocks. Now, these are just examples, but the important thing is that if there is a combination of different, let's say, features, some ratios point towards the company being value, but others suggest that it might be growth. So a combination of value and growth, because the adoption of the ratios used in the scoring system may not always project a very clear picture. So if there is a combination of value and growth features, we call that blend or core, and it's going to be especially common for larger companies. Why? Because large companies may have, different business divisions, some of them being representatives of the value segment, others being of value style, others being representative of growth, and it typically relates to some segments being very mature, so perhaps suggesting value, others being high growth, in the high growth stage, so not really producing earnings yet, but already being valued quite highly, and that blend creates a less than clear picture in terms of the different ratios. Okay, now the book also includes or contains sort of several remarks about why this kind of matrix might be useful to investment managers, to asset managers, including the fact that you can use this setup, this matrix, to track a company's progress over time as it shifts from being a growth company to more of a value company. So, often what happens is companies start somewhere over here, they're small, then they grow in sizes, and as they grow in size, they kind of migrate towards being perhaps value stocks as they mature. Right, but that's just one possible use of the matrix, or one advantage of using this matrix to track a company's evolution over time. Then we come to the very obvious segmentation by geography, and the book suggests that most commonly this will be based on not necessarily just a country basis, but the stage of macroeconomic development. So commonly, we will split the investment universe geographically into companies from developed markets, companies from emerging markets, and then even more extreme than emerging would be so-called frontier markets, which are only sort of beginning to open up. Your curriculum contains a warning. The warning is such that if you go for segmentation, let's say by country, which is of course done quite often, don't necessarily identify the split by country into or don't equate this. So this is not equal to market exposure. There is a nice example there, which I think I'll just replicate and tell you, namely Swiss companies or Swiss international, companies like Nestle, for example. Nestle is based in Switzerland, so it would fall into the Switzerland category in terms of Swiss segment. But in fact, most of its revenue is derived not from Switzerland, it's actually elsewhere around the world. In fact, I think they say in the book that only around 2% of Nestle's revenue is derived from Switzerland. Everything else comes from other markets. So being based in a country doesn't necessarily mean you're exposed to just the factors from that country. An important note to consider. Now, the third type of segmentation or way to segment is by economic activity. And this is basically splitting companies, dividing companies up by their industries, their segments. And you did a lot of work at level 1, I think, on sort of segmenting companies by sectors and industries. There are that there are different ways to do this, different methodologies. Your book kind of talks about this, but this is not something that would be testable at level 3, I don't think, in terms of you having to remember what categorization or classification does what, or how many categories it has. Your book just talks about it, I think, to fill in a bit of space in the curriculum. Just know that this is split into industries and sectors. And finally, we've got segmentation of equity indexes and benchmarks. So as you will know, there are indices, there are benchmarks, and those benchmarks typically reflect some or sometimes even all of the above approaches. So examples of this would be the MSCI being a big sort of indexing company or benchmarking company, emerging markets large cap growth index or benchmark. So that would be an index composed of companies that come from emerging markets, segmentation by geography. They are large cap, segmentation by size, and also growth companies. So an element of style there, right? That's just an example. Investment analysts can use benchmarks and indices to segment their portfolios and investment universe in a way that combines the different features.